The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
To what degree will the U.S. war with Iran affect financial markets? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to Closing Bell here in the U.S. What an interesting equity market we're taking a look at right now. The S&P 500 was lower by more than 1% earlier in the day. You can see it's since really taken back those losses higher by about 0.3%. And then you take a look at what the small caps are doing. The Russell 2000, actually your big outperformer on the day, higher by about 0.9%, which is interesting because we are seeing a big sell-off when it comes to the U.S. Treasury market. Initially, you did see that knee-jerk haven bid come in. Now 10-year yields higher by about 11 basis points as investors really ask what this is going to mean when it comes to inflationary pressures. A lot of that comes down to what's going on in the oil markets. You take a look at Brent right now, higher by about 6.4%, Romaine, and a lot of questions about where it could climb to.
Interesting to look at that screen here at 3 p.m. New York time. You go back 8 or 9 hours ago and that 1% gap lower in the S&P futures overnight, that 12% gap higher in Brent crude paired as the day went on. Not the extreme market moves that would suggest a teetering of financial markets, but that doesn't mean that we're in the clear. The bigger risk is likely less directly about the instability in the Middle East and more so about the return of volatile policies in Washington. Volatility that, quite frankly, just a few months ago, most folks thought had actually settled down for good. The other big concern, as Katie had on her board, is inflation, particularly with the dollar rallying the most in 10 months, Brent crude trading at its highest intraday in 14 months, natural gas prices in Europe spiking more than 50%, the most in 3 years, and throw in a U.S. manufacturing report that showed input prices in February soaring at the fastest pace in 4 years, all that leaving investors to revisit some of those discounted cash flow models. But keep in mind, long-term geopolitical events historically haven't resulted in sustained volatility or sustained drops in U.S. equities. Morgan Stanley strategists see Iran and what's going on over there unlikely to derail the bullish view on stocks. However, RBC strategist Lori Calvasina, she cautioned against fully embracing that historical precedent, saying that while the bulls are technically correct, the market outcome still depends on just how limited this military conflict will go.
Meanwhile, I did want to take a look at global OPEC production because, again, a lot of focus on oil, as Romaine mentioned here. So just to put it into context, take a look at this pie chart behind me. You can see that Saudi Arabia accounts for about 10%. So really the leader there. You also have Iraq, the UAE, Iran up there as well. Iran, 3.3%. That is what is in focus when it comes, again, to their output and what they contribute to those OPEC plus production numbers. But it's not just, of course, their sheer output numbers alone. A lot of focus on the Strait of Hormuz. Of course, Iran borders that and has a lot of influence over the flow of oil through that strait. So that's one of the big questions, Romaine, and one of the worst case scenarios. If you do see a situation where the strait is shut down for any significant amount of time, what does that mean for the flow of oil around the globe, and what does that mean for price levels? All
right, let's kick you off to the close right now with Liz Thomas, head of investment strategy over at SOFI. And while there certainly is a narrative and maybe some concerns in oil markets, maybe even in the FX markets to an extent, when you look at equities, Liz, and the big dip buying that we saw come into this market, is that reflective of the idea that these geopolitical issues, at least long term, don't always have a meaningful downside impact on markets?
Really healthy that investors have come in and gotten more rational even since the pre-markets today. If you look at historical periods of geopolitical spikes in risk, and that's, first of all, important thing is that spikes for a reason. They spike up and then they fall back down. It's all very shifted usually. So when you look at historical periods of these geopolitical spikes, stocks actually tend to see cyclical sectors outperform defensives in a subsequent one-year period. So typically there is, a little bit of an upset in the near term. There's sort of this rejiggering of risk appetite, but investors that are able to set some of their emotions aside and look at some of these entry points, because markets do tend to overreact in the near term, have been better set up over the long term.
This also, though, does get to the idea of the potential risk to profits and margins if we are going to start seeing a higher dollar, or inflationary pressures return, and more importantly, persist. I know it's still too early to really know whether that does become the case, but if that does sort of materialize in the longer term over the next few weeks and months, does that change the bull thesis for equities?
Personally, I don't think it changes the thesis for as inflation still remains under control. I do think that coming into 2026, investors have it on their radar that inflation might be warmer than we had hoped, especially all the way through 2025. And markets were already showing that by not expecting a rate cut until at least summer. Now we don't see a rate cut until it looks like July at the earliest, as far as markets are pricing it, and even the expectation of fewer cuts this year have come through markets today. So I don't think that markets necessarily cuts, and I don't necessarily think the economy needs cuts in order to remain stable.
I do want to talk a little bit about what's going on.
Drives an inflation shock to the upside and it's sustained, then we would certainly have a problem.
And Liz, I do want to talk a little bit about what's going on in the bond market, because as I mentioned, you take a look at 10-year Treasury yields right now, higher by about 11 basis points, which certainly if you were just looking at those numbers cold, you wouldn't know what's going on, what's unfolding in the Middle East right now. What do you make of the reaction function there? The idea of first of buying Treasuries as sort of a haven bid, now selling them off because there is that concern about those inflation fears. How do you think this settles out?
Yeah, I think originally in the morning, it was a similar reaction to equities. There was a lot of consternation in the market. Risk appetite waned very quickly because this was the first open and market reaction we could have since the conflict erupted. And then as the course of the day went on and we looked forward and realized, okay, perhaps bring calm to markets, then you have sort of the reverse reaction. So I think a lot of this is all in line with what happened in equities.
All right, Liz, really appreciate your time. That is Liz Thomas. She is head of investment strategy over at SOFI. And of course, as the Middle East conflict, it's sending shockwaves through commodity markets, with oil surging amid a near halt to traffic through the Strait of Hormuz and a disruption at a major refinery in Saudi Arabia. Here to discuss all the different implications is Arjun Murti, partner of energy, macro, and policy over at Veriten. Arjun, great to have you with us. So there's a lot of worst case scenarios floating out there, particularly when it comes to the Strait of Hormuz, what a prolonged disruption might look like. What right now is your base case, and how different is that from the worst case?
So far, markets have taken this in stride, I would say, for what is obviously a very important oil exporting region. It's also a really important LNG exporting region. I think that part of the story has perhaps been somewhat underreported, but at least so far, we've not seen the major attacks on oil infrastructure. I think that would be the kind of tail risks one would be watching. The lesson of recent geopolitical turmoil is these things tend to be short-lived and fade. But I think this is a very unique situation in that it involves Iran, it involves the Middle East. And so there's prior examples of Russia, Ukraine, Venezuela, and so forth. I'm not sure there's a good analogs for this situation.
Yeah, it's interesting, and it touches on a point I've been wondering about. You think about past geopolitical events over the past couple of years, it's really difficult for oil to maintain a sustained sort of geopolitical move. It sounds though, Arjun, what you're saying is that might not be the playbook this time around, that we could be headed to maybe some more sustainably higher price levels.
What I would say is that we are certainly hoping for things to ultimately get resolved in a peaceful manner and for there to not be attacks on any of this infrastructure. But I also don't want to be complacent about tail risks. For oil markets specifically, those tail risks can be to the upside, both stuff with the infrastructure, but they can also be to the downside. There is a downside scenario by which you do damage to the global economy that, again, we're not seeing yet in markets. That's the kind of tail risk we worry about. But we've used the phrase super volatility as our sort of framing for oil markets, and I think that's here to stay. I will say two other quick points. OPEC has brought back on a lot of the oil that they've taken off in recent years. Their level of spare capacity isn't what it once was. And while I think in a much higher oil price environment, shale oil supply in the U.S. could respond positively, at the moment, we're otherwise seeing signs of maturity. So I do think the outlook for oil markets beyond this current geopolitical event is actually pretty positive looking out over the next 5 to 10 years. But core to that is always healthy global economic growth. So we are mindful of ensuring that we don't have some of those downside tail risks to the global economy.
With regards to just, I mean, not only just the production, but obviously the issues of supply, Arjun, is there sort of a possibility that when we look at what happens in the interim, assuming that if the Strait of Hormuz does stay closed for an extended period of time, that there is enough capacity out there that can circumvent that strait to at least keep prices from going to extreme levels? I know they're going to be elevated, but not go to the extreme levels.
People are familiar with all the oil that's on the water and all the sanctioned oil that's been on the water. Clearly, some of that can help fill a disruption in the straits for some period of time. So it's going to be a question of how long it's disrupted. I think the market people should be watching is LNG markets. That is an area where all of Qatar's LNG exports goes through the same straits. And the ability to be flexible, the ability to ramp up in other areas, the ability for spare capacity to fill the gap is not so great. So I think from a European perspective in particular, they've replaced Russian gas with LNG exports. And I think if those LNG exports come at risk, I'm going to be more mindful of those risks, which I think the market is speaking a little bit less about at this moment.
Well, we have heard a lot of people talk about it, and we've seen the spike, at least in European gas prices, up as much as 50% at one point here on the day. But it gets to the idea, though, too. I mean, does that price hike, that price jump, and I know it's primarily what we're seeing in European futures, is that something that would have broader impact on the energy space, not just with regards to European-based LNG?
I think you're really correct to highlight that this is a bigger risk for Europe. So while oil is more global and the impacts of higher oil prices impact the global economy, I think if we look at America or the United States specifically, you're not seeing very much of a reaction in Henry Hub gas prices, our local natural gas prices. And so it is a bigger impact. The risk would be to Europe from the LNG issue.
How do you see it potentially flowing through to the U.S. gas picture when it comes to the American consumer at the pump? I mean, talk to us about what that looks like, even though, you know, the line is more direct when it comes to Europe.
You know, so prior to any of this Iran turmoil talk, the expectation was that oil prices are going to be closer to $60 a barrel. Some even had it in the 50s versus where we are today. So we're already going to see some impact from higher pump prices. But I think we're pretty blessed in America that overall our pump prices tend to be amongst the lowest in the world. And while for some period of time, maybe it's 6-9 months, we might be facing higher pump prices, there is a shale reaction function that will come, certainly if oil was to sustain at $75 to $80 a barrel. So, you know, I worry a little bit about pump prices in some of those extreme tail risk scenario of a much broader disruption of energy export impacts in the Middle East. But I think at the time being a little bit of pump price pain, if you will, but you know, it's more manageable for Americans than I think some people would have feared.
Arjun, Murti, partner of energy macro and policy over at Veriten. A closer look here at the reaction that we're seeing in energy markets. And of course, what energy prices do next is largely going to depend on, quite frankly, what the U.S. military does next. We do now want to turn to that side of the story with the president of the United States saying that the U.S. would continue to do whatever it takes. The big question is, what is the end game here? Are we close to it? And exactly what ends up being sacrificed to get there? Joining us right now is retired U.S. Army Brigadier General Mark Kimmitt, also the former Assistant Secretary of State for Political-Military Affairs and former Assistant Deputy Defense Secretary for the Middle East. And General, I do want to start off with this idea of, I think what, at least here in the United States, the political and military discourse for years has always been about trying to find a way to neutralize Iran's threat to the Middle East, Iran's threat to the rest of the world, making sure that its nuclear program, or whatever was left of it, was indeed demolished, that there was sort of a regime in place that, to some degree or another, could coexist with the rest of the world. Based on what we know now, today, are we closer to that goal?
Well, first of all, I should note that before demolishing it, the United States went through a series of negotiating sessions leading up to the JCPOA back in 2016. And of course, the Trump administration has tried negotiations as well. Even President Biden tried to restart negotiations. but I think we're closer to a non-nuclear Iran, and I think that it's going to take a long time before that happens. I don't think it's going to happen simply by military power. I think at the end of the day, it's going to have to come at the negotiating table between the United States and a more moderate Iranian regime.
Do you think we're going to get a moderate regime? I mean, at least as of right now, it's basically the hardliners, or at least what's left of them, in charge. Do you think we would get to the point where there would be enough of a moderation in that leadership that would actually negotiate in good faith with the U.S. and the rest of the world?
Yeah, that's a great question. I think if we take a look at what's happened in the last 2 days with Ali Larijani back and the original leader of the Iranian Quds Force back replacing the Quds Force commander, it doesn't look at this point like we're going to be seeing any Jeffersonian Democrats anytime soon. The question the president now has to have, and the Israelis need to have, do we take the Hezbollah model where if we don't like these guys, we go against the second tier of leadership and the third tier of leadership until we finally make it clear to the Iranian leadership that you better put some moderates in there, otherwise this will continue.
And I had a conversation with the Director General of the International Atomic Energy Agency earlier today, making broadly the same point to you, basically that there needs to be some sort of negotiation. Just bombs alone aren't going to exactly solve this crisis here. But to that point, General, I wonder what sort of timeline we're talking about. I mean, it's unclear at this point who would be even at the negotiation table, to Romaine's question here. So, I mean, over what sort of time frame do you think that resuming diplomacy would even be possible?
That's a question that only the Iranians can answer. The Americans are willing right now to go back to the negotiating table. I would say that the Iranians now would have to concede their nuclear program, their proxy program, and their ballistic missile program before we would sit down and stop the pain. There's plenty left to negotiate after that. Sanctions relief, economic assistance, helping to solve the water crisis, helping to end the amazing level of inflation that they have inside their country. But I think at this point, the United States is going to hold firm on the issues of the nukes, on the issue of the ballistic missiles, and on the proxies. And the only people that can answer when they're ready to return are the Iranians. Now, just because we've taken out some of their security forces and, of course, the supreme leader, you know, Arakchi is still in place, the foreign minister. He has all of his negotiators that were alive last Thursday are still alive now. I think we won't know until the new supreme leader is appointed by the Council of Experts about whether they will be willing to concede the points and come back to the negotiating table. So my trigger would be, let's see when the new supreme leader comes in, and let's see what happens after that. But I don't think they will negotiate before the new supreme leader is in place.
Well, also on the topic of timelines, we heard from Defense Secretary Pete Hegseth earlier today, basically rejecting the idea of a, quote, endless war with Iran, saying that this is not Iraq. Of course, you have intimate experience with Iraq. You were involved in that regime change environment back in 2003. We know the president is saying that this could stretch out to more than a couple weeks here, more than 4 to 5 weeks. But taking a look at the situation as we understand it right now, do you think that this is a conversation where we should be talking about potentially years here?
Well, between you and me, I don't think we've got enough ammunition to continue this for years. I'm certain that we can continue the pressure, economic and other manner in which to compel the Iranians back to the negotiating table. But as long as we don't now engage in mission creep, where we want to put boots on the ground, where we want to promote democracy, when we want to arm and equip the protesters, as long as we stay to our fundamental war termination goals, which is no nukes, reduced ballistic missiles, and a commitment to end the proxy program, I think we can get this done fairly soon.
I am curious, though, do we have any insight into what sort of the armaments Iran has right now. And I ask that because we talk about this idea of the potential issues with the Strait of Hormuz and the volleys being lobbed there, the missiles, of course, that have been directed at some of the other Middle Eastern countries here. Is that something that could potentially be exhausted anytime soon? Are the Iranians still being supplied with anything by anyone?
Well, unfortunately, our friends, the Russians, have been working with them for years and years, providing them drone capability. I'm afraid that they've got enough drones, in our estimation, to keep it going for quite some time. Much of the Iranian Navy is exploring the bottom of the Persian Gulf right now. I think our U.S. Navy is the uncredited heroes. We've got to keep that up against the Iranian Navy and their ground naval components to keep the Strait of Hormuz open. Unfortunately, commercial shipping right now is afraid of going through the Straits of Hormuz, and we've got to demonstrate that that's back open the way we did with the Red Sea. That will take some time. What I'm most concerned about are the weapons that don't leave the country, and that's the artillery, the tanks, the mechanized vehicles. I'm old enough to have lived during the Hungarian Revolution, during the Czechoslovakia Czech Spring, and the Shia Rebellion in 1992. In all of those cases, the dictators in the Soviet Union and inside of Iraq basically took those tanks and ran over the protesters. And I think we've got a real decision point if the military holds firm and loyal to the regime.
All right, General, have to leave it there. So appreciate your time and perspective. That is retired U.S. Army Brigadier General Mark Kimmitt. Now, despite the lack of action in the financial markets, the Iran war will certainly impact the broad global economic landscape. JP Morgan Chase CEO Jamie Dimon sat down with our own Lisa Abramowitz on the side of the bank's Global Leveraged Finance Conference, where they discussed if the U.S. economy and markets can withstand a large geopolitical shock. Here's part of that conversation.
One of our brilliant folks wrote a report years ago, Mike Semblis, that if you look at all these wars around the world since World War II, the market reacts, but it never had a real long-term effect other than the Israeli conflict, where oil prices tripled and went on for an extended period of time in 1973. So the world kind of takes its stride, but geopolitics is a major issue. It's much more complex today than it has been since World War II. I'm talking about Ukraine, Russia, Iran, North Korea, our relations with China, and that could have an effect, but it may not. So these things may diminish over time. This war with Iran, if it is short and oil goes to 80 or 90 or 100, but it's a short time and not prolonged, it probably won't have a major effect. If it becomes prolonged, then all bets are off the table.
Well, how offsides would this market be if there were truly a stagflationary shock, given the fact that there seems to be comfort with the idea of disinflation right now?
Well, I think that's true, but I think that was true before this war. So if you look at, my view is the prices, asset prices are kind of high, credit spreads are kind of low. There's kind of a lot of complacency in the market. I'm not sure, we look at risk, we look at the broad range of outcomes, and there are negative outcomes, but one of them would be, inflation. I call that's the skunk at the party. So it's been coming down, but it seems to maybe have leveled off around 3%. If things make it go up, and this is only one thing, you can look at medical prices, construction prices, insurance prices, wages for certain things, other things, inflation is a big thing, it's not just oil. So we'll see. Right now, this will add a little bit, literally a teeny bit to inflation, not a lot.
I was surprised because things were kind of gloomy coming into today, and the mood here is not that. Actually, there's a lot of optimism. There are a lot of different companies that are building things and investing things. I mean, how vulnerable really is the U.S. economy right now to some sort of geopolitical shock?
Well, it may not be geopolitical. It may be the companies will start to lay people off. And so I look, the most important thing in the world today is geopolitical. What happens to the free Western democratic world, which has kind of been under attack by Russia and Ukraine, by Iran in the Middle East, a little bit by China, who wants to, divide and conquer the Western world, and, both militarily and economically. You have all their neighbors are rearming because of their actions, not because of anyone else. So those are the most important things. I'd add global deficits are so large, but those are like, I call them like large moving tectonic plates that may or may not affect the economy in the short run. They may be determinative in the longer run. And some of these things, when you talk about war, Vietnam, did it affect the economy in the very short run? No. It had a 20-year effect after that. So you got to look at these things as they're moving plates that can take 5 years to have an effect, but effectively real. Right now, the economy is doing fine. Asset prices are high. People are assuming things go on. I mean, nobody you talk to has any idea that credit spreads can gap out a lot. And they could, just because of sentiment. And so yeah, I think there's a little bit of, a little more exuberance than I think there should be. But we've had years of it. And the one big beautiful bill adds to, adds to growth this year. Bank deregulation, other deregulation adds to growth, and animal spirits. So we'll see. But you pointed out, I think the skunk would be inflation. So we got to keep our eye on that one closely.
Yeah, well, and this actually speaks to something that people are wondering, which is what's going to potentially crash the party. Before we get into credit more significantly, I know that JP Morgan has been expanding significantly in the Middle East, particularly in Riyadh and Dubai. If you take a longer term view, does any of what we're seeing now have the potential to shape that effort to expand either in the positive direction or potentially to withdraw in the effort?
I think the way I look at it, it creates more risk. It creates more chance of a positive outcome. So all those nations have been modernizing, educating their people, adopting more and more Western methods, wanting to open up their markets, bring in foreign direct investment, invest overseas. That won't change. In fact, and Tom Friedman wrote about this in his paper today, that this creates a bigger opportunity for long and just peace in the Middle East. And writ large, not just Iran and this war, but that Saudi Arabia, UAE, some path to statehood for the Palestinians in Gaza and Palestinians, that's going to be up to them. There are reasons to be optimistic. This opens the door for that.
JP Morgan CEO Jamie Dimon addressing the conflict in the Middle East. And as he were speaking, we should point out S&P flipping from green into red, and Brent crude futures rising about 3 percentage points from where we were just about 25 minutes ago. This is based on a headline from Reuters that Iran's Revolutionary Guards commander has said that the Strait of Hormuz is closed. It also says that Iran is set to set any ship trying to pass through there on fire. We're also getting additional headlines, this coming from Iran State TV, saying that it won't let oil leave the region. Again, these are reports coming from different sources from Iran State TV and Reuters right now. Bloomberg is trying to confirm them, but there is a market reaction here with crude prices drifting back higher in the S&P, drifting lower here. We're going to get you some more information on that as soon as we can and bring it to you first right here on Bloomberg. When we come back, we're also going to have part of our exclusive interview with BNY CEO Robin Vince. He also did address the situation in the Middle East and how his company is using technology to keep the money flowing. That's coming up next here on The Close on Bloomberg. 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostic.
And I'm Katie Greifeld, of course, keeping a close eye on these markets as we monitor the situation when it comes to what is unfolding in the Middle East. Of course, keeping a close eye on Brent, spiking a little bit higher right now, Romaine, currently higher by about 0.9%, not too far off the session highs of the day. Yeah, and stocks, when we started the show, your board, of course, had the S&P in the green. That's now in the red. A testament here to some of the volatility that we're seeing in this market as the situation in the Middle East is still fluid. We are going to get back to that a little bit later in the show. But we also wanted to talk about what's going on in the world of banking, and more importantly, when it comes to the intersection between banking and technology. BNY, it's a 242-year-old bank, actually founded by Alexander Hamilton here in the U.S., and it says it's in the age of transformation. That company, it leads its big bank peers right now in tech spending more per revenue than any other bank out there, and is trying to get its employees on board, rolling out digital employees, creating an AI hub, an enterprise AI platform called Eliza that's integrated with Google's Gemini. And it's actually starting to show up in the numbers, at least according to BNY CEO Robin Vince. I had a chance to sit down with him for an exclusive interview today. It was actually the first ever done inside BNY's Cyber Technology Operating Center, the heart of its tech efforts. Here's part of that conversation.
You're sitting in exactly the right place to talk about technology and AI. This is our Cyber Technology and Operations Command Center. And remain here for our clients. We're really looking at everything that BNY does with our clients and helping them and wrapping our security around all of their assets, all of their data, because at the end of the day, we touch so much of the world's financial assets and data that being secure, being resilient is incredibly important. And that's really table stakes. And this is one of our command centers where we really monitor all of that. So you're very much in the nerve center of BNY right now. Now, You're right. I think these days, to be in the world of AI, to be a good CEO, you have to be very, very thoughtful about what's happening in technology, because once upon a time, there was probably a world of running a company and then having engineers think about how to drive technology forward in the company. Those two things now are much more inextricably linked with each other. We view AI as probably the most disruptive technology with some of the greatest opportunity that we've seen in our generation, probably for several generations. And so being at the forefront of that, thinking about how can AI really infuse our company, the depth as well as the breadth in service of our clients. So all the work that we've done over the course of the past 3 years in repositioning, reimagining BNY has now brought us to the point where culture and the whole team can help us with the implementation of AI. We're also partnering, of course, with our clients. We want to deliver better technology, better services, better product, more responsive, more efficient, quicker. We just onboarded some customers a few weeks ago in 7 minutes in something that would have otherwise probably taken us 7 weeks. So the speed of our ability to deliver for customers is changing. And it's also a team sport with the AI industry, partners that we use, the big LLMs. We've built a platform inside the company. It's called ELIZA, and we're connected to all of the general intelligence models. And we've created this ecosystem where we can plug other people's agents into our ecosystem and actually unplug our agents into others' ecosystems. So collectively, using the very best of what's available in AI, joined up with BNY data and our customer prowess, and being able to push forward.
We are doing this interview on a day where there is a lot of tension in the Middle East. I am curious about what sort of measures were already in place here in BNY to make sure that there was continuity in transactions, continuity in services, given the potential disruption of some financial operations overseas?
Well, resiliency is something that's always about preparation, and it's the work that you do ahead of events that ultimately makes the difference. And this is, again, another team sport. The whole of BNY is about bringing our people together, joined up, and thinking about what might happen in the future. Risk management, I used to be a risk manager. And as a CEO, you're always in the risk management business. What could go wrong? What could happen? And then the preparation and deliberate work to be able to prepare for those eventualities. Some of that is wasted effort because some of those things you prepare for may never happen. But by trying to cover as many of the bases as you possibly can, you're ready for more different events. And then when clients need help, we're there to be able to support them. And we have many clients who look to us very specifically as a company because of our resilience to be able to help them through difficult times. People have cyber attacks, people have disruptions in their businesses, and we can actually help our clients go through some of those. But you have to be humble about resilience, because it's always about preparing for what might happen, the unexpected, and remaining as a team always focused on being ready.
Since you joined the bank and took over as CEO 5-6 years ago, you put a big emphasis on increasing the amount of money that you spend on technology. Right now, I think something around 19% of your revenue is going to technology spending. That's probably the biggest share on Wall Street right now. Do you plan to increase that?
Well, look, I think it's a sign of the types of businesses that we're in, because one of our biggest investments is technology, because we're in the business of data. We're in the business of being able to provide straight-through capabilities. And so in some ways, delivering our technology to customers is kind of what we do. We're not in the investment banking business or the retail business. And so the nature of our products requires us to be heavily invested in technology. Now, I think what we're seeing at the moment, and what we'll probably continue to see over the course of the next few years as AI really rolls through the ecosystem, is that we can actually do more with our investments in technology, because AI is such a huge efficiency leverage in technology. We can write code quicker, we can write it more efficiently, we can do things that used to be prioritized below the line that maybe we weren't able to get to, and now we can actually do them because we've got more capacity. So I don't necessarily see it increasing, but what I see is the productivity of our spend being able to grow.
Have you articulated that to investors? There's been a lot of talk about the amount of money companies are spending on AI infrastructure and everything associated associated with it and the inability to articulate an actual return on investment. Is that the proper way to look at it within BNY?
I think for us, I would look at it in a few different ways. The investment in AI is going to create efficiency in the company. Now, for us, efficiency means more capacity. We would love to be able to do more things without having to grow our headcount and our expense base. And AI in that respect is a gift. We can actually increase our productivity, which gives us more capacity to be able to do more to serve our clients. That's one vector. The second vector, which is very important, is about infusing AI into the products to be able to make them better, more knowledgeable, being able to look around corners, present answers to customers before they even know that they have the question, being able to speed the insight into action. And AI is doing all of those things. We have 160 AI solutions in production. We have 140 digital employees who've joined the workforce over the course of the past year. And that's at a point where we now expect that to accelerate even further, to be able to allow us to do more. And then the third vector is actually just, what does AI enable you to be as a company? Are there things that you could do that you previously couldn't do? Are there businesses, there are opportunities maybe to approach new products that we otherwise wouldn't have been able to do? So I view it as all three lenses.
You talk about your digital employees. You've spoken about them in the past. These aren't people, as you said. These are basically what? They're agents? Is that the way to think of them, or something deeper?
They're multi-agentic solutions. And so our approach to AI is built up by having a series of different agents trained. Think about them as very specialist trained capabilities that work together to pursue a task. A little bit how a human would operate. A human doesn't just have one skill, they have multiple skills. And so bringing those multiple skills together and then bundled in the form, and the difference between a solution and a digital employee for us is with a digital employee, we add some additional things. We add a login ID, we add email, we add the ability to be part of our corporate directory. They have managers. And so as a result of that, our people can collaborate with digital employee team members and actually use them as they might another more junior member of the team. And so it's a different way of operating in our environment. And we view both as quite important.
The CEO of BNY, Robin Vince, and don't miss my exclusive conversation with two of his key hires, two of the executives that are really actually driving the bank's tech transformation. That's coming up in the next hour right here on The Close. But when we come back after the break, we are going to turn back to the Middle East conflict and the impact that we're continuing to see on stocks, particularly in the travel space. Cruise operators down significantly on the day. A deeper dive as part of our Stock of the Hour right here on Bloomberg. Today's Stock of the Hour takes a closer look at cruise ship companies. Shares of Norwegian to Carnival and everything in between falling largely on fears of disrupted global travel from the conflict in the Middle East. There was also an earnings report out of Norwegian Cruise Lines that didn't help matters either. Brian Egger joins us right now, senior gaming and lodging analyst for Bloomberg Intelligence. So Brian, let's first start off with the turmoil in the Middle East, the impact that we're seeing, at least certainly today, on stock prices in that space, and whether that is actually going to translate or somehow a reflection of any potential for reduced bookings. Do geopolitical events like this have that type of impact?
So at least with respect to Norwegian Cruise Lines, they have not observed any bookings disruption. And there is some precedent for this type of geopolitical conflict. If you go back to the Gaza-Israel conflict, cruises to the Israeli region representing about 4% of annual capacity days were canceled. So we've had past Middle East region conflict before, which can result in cruise cancellations. We have not yet seen any evidence of consumer disruption in terms of bookings, but the conflict is quite new. And I will point out that the decline in Norwegian Cruise Line has some unique company-specific elements that have less to do with the Middle East conflict and more to do with some company-specific situations.
Well, Brian, we only have about a minute left, but let's talk about some of those company-specific situations, because we know that Elliott, for example, has disclosed a stake of more than 10%. They've criticized management in the past, and they actually just issued a statement saying that their outlook for 2026, Norwegians that is, falls short of potential and that there is an urgent need for Norwegian board refreshment. We know that they've already replaced the CEO. What do you see in the offing here in terms of the Norwegian response?
And to your point, you're right. The guidance for net revenue yield growth in 2026 being flat is a contrast to about 2.5% growth for Royal Caribbean and for Carnival. And I think they've got a series of execution issues related to technology, deployment, management realignment, kind of making sure they're commercializing correctly their overall deployment strategy. Not a new CEO in the helm. He's only been there for about a week. And I think this does follow, as you pointed out, the activist involvement. So right. I think the situation dovetails with the Middle East conflict, but it is separate.
All right, Brian, really appreciate it. That is Brian Egger of Bloomberg Intelligence. Meanwhile, 15 minutes away from those closing bells, we'll take you there with Ed Yardeni next. This is The Close.
This is a bigger risk for Europe. So while oil is more global and the impacts of higher oil prices impact the global economy, I think if we look at America or the United States specifically, you're not seeing very much of a reaction in Henry Hub gas prices, our local natural gas prices. And so it is a bigger impact. The risk would be to Europe from the LNG issue.
Arjun and Murti over at Veriten, kicking us off to the close a little while ago. We should point out Brent crude prices right now around $79 a barrel, WTI around 72, both up about 8% above where they were a day ago.
It's interesting because you're seeing that big reaction when it comes to the energy markets. You're seeing that big reaction when it comes to the treasury markets. You're not necessarily seeing it when it comes to the equity market. The S&P 500 pretty much flat on the day. It was down by more than 1% at the open. Certainly feels like a long time ago. And then the small caps, riddle me this, higher by about 0.9%, even with that big rise that we're seeing in treasury yields. So stock bulls shaking it off. Can't say the same for the cross-asset landscape.
Yeah, it was kind of interesting this morning. I mean, I was reading that note out by Mike Wilson, kind of pointing out this idea that at least with historical precedent on these geopolitical events, that sometimes does not last long. Let's bring Ed Yardeni into the conversation, President and Chief Investment Strategist over at Yardeni Research. And Ed, I do want to start there with the idea of this buy the dip moment. And, you know, we've seen in the past when you've had these big geopolitical shocks, you get a knee-jerk reaction. Sometimes you get some lingering effects and things like oil or the commodities that are more directly affected. But specifically when it comes to equities, what is it that's drawing people back?
Well, look, I think everybody seems to know by now that geopolitical crises present buying opportunities. And because everybody knows that, there's a lot of buying that occurs just on the news before the market even goes down very much. So there's a lot of that going on. I think also the market tends to look where this is all going. And I think the message from the market is this is not going to be the 70s all over again. This is not like 1973 and 1979 where we had energy shocks causing inflation, causing interest rates to go up and being very bearish for the stock market. Quite the opposite. It seems to me that if this turns out to be a short war, and I think the war is already over, it's just the Iranians don't know it. So there's still apparently a lot of soldiers firing at their neighbors in Iran that just are basically out of control. There's no command and control in Iran. But this war is, for all practical purposes, almost over. And I think if that's the case, if it turns out to be several days or a few weeks, then the market's looking beyond that and saying, well, this may actually increase stability in the Middle East. Finally, we may have more Arab countries joining the Abraham Accords with Israel, and just less terrorism in that neighborhood.
And I do just want to point out the Secretary of State, Marco Rubio, is speaking right now to reporters in Washington ahead of a briefing that he's going to give lawmakers. And he talks about this idea of trying to remove the Iranian Navy threat there. And a lot of talk about that, not even necessarily about regime change, but the idea of removing that Navy threat, getting the Straits of Hormuz back and up and running in a somehow normal functioning way, which obviously would bring energy prices back down in theory.
Well, from what the president said, it seems like their Navy's already been sunk. It doesn't look like they've got any naval presence. The only thing they can do is maybe from the land, because the Strait of Hormuz is relatively narrow, is shoot some drones and missiles at ships. And that's just going to take a few more days to figure out where they're coming from and to devastate those launchers. The Strait of Hormuz, practically speaking, is open. The problem is insurance. The ships don't have insurance to be in a war zone, which they suddenly find themselves to be in. And if this thing gets resolved fairly rapidly, as I expect, the straits will be open and the price of oil will come down rather rapidly.
Given that that is your expectation, I mean, again, you take a look cross-asset right now, would you fade some of these moves that you're seeing in the bond market, in the energy markets? It feels like when we take a look at the stock market, that dip was already bought, but would you buy the dip in treasuries, for example?
Well, I think treasuries have been in a trading range really for about 3 years now. Somewhere between 4 and 4.5%, maybe a little bit higher occasionally, maybe a little lower occasionally. But I think with treasuries, you're basically going to earn the coupon. As an investor, I don't think you're going to get much in the way of capital gains or capital losses over the next several years. Treasuries, in other words, are where they should be. I'm not even sure that the Fed is going to have to lower interest rates, given that the economy is doing well. And meanwhile, inflation is still a little bit on the hot side, as we saw in the PPI. So no, I would focus on just not doing anything. Just stay invested in the stock market, stay invested in the bond market, have some gold in your portfolio. Nothing really changes from my perspective that the economy is resilient. It's dealt with shocks like this before and done rather well.
Yeah, and to your point, I mean, you take a look at the 10-year Treasury yield. It's at 4.04% right now. We've more or less been around these levels in a broad band since September or so. But you mentioned inflation, Ed. You think about the ISM manufacturing figures that we got this morning, the fact that you've already seen input costs on the rise for manufacturers. How concerned are you about the inflationary backdrop at this point?
Yeah, well, I do agree with Kevin Warsh, the fellow that's been nominated to replace Fed Chair Jerome Powell. I do believe that AI and other technologies are, in fact, boosting productivity, and that productivity will be a great disinflationary force that will offset some of the inflationary forces that still persist. So I think inflation by the end of the year is going to go down to 2%. And of course, in my short war scenario, the price of oil would be coming down, and that would also help to bring inflation down.
All right, Ed, always an illuminating conversation. Ed Yardeni is president and chief investment strategist over at Yardeni Research. And I do want to point out, too, I mean, Dan Curtis, who helps to lead a lot of our markets coverage here on Bloomberg Television, was kind of pointing out, really pay attention to the moves in gold, because that's kind of having a feed through into risk on or risk off sentiment that we're seeing in equities. He kind of had a great chart he showed me this morning, kind of showing that big drop that we saw in gold prices, the rise, and then, of course, the drop, which coincided with the rise that we would later see in equities. Yeah,
it's always nice when Dan Curtis comes to New York City, and it is a really interesting move that we're seeing.
American.
He is an American. Yeah. He lives in London, for those keeping track at home. In any case, gold is one of those assets that has held its gain. It was above $5,400 an ounce. It was a long week vacation that I went on. But it's interesting. I mean, how high can it go? Since it seems like that is one of the asset classes that has priced in a sustainable risk premium at this point.
Despite, of course, all of the concerns coming into this session, we should point out right now equity is pushing back into the green as we move closer to the closing bells here. About half the stocks in the S&P are in the green here, and barring a big move lower over the next couple of minutes, that is potentially where they'll finish. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. It started. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube as we continue to track the market movements on the tensions in the Middle East.
What tensions? Look at the equity trade. It's like meh. I'm kind of shocked by it. I know the Treasury trade's a little bit of a different story, but kind of fascinating to actually see some slight gains, as little as they may be, on both the S&P and the NASDAQ, considering we have, a war in the Middle East.
Okay, well, I got something for you. How about WTI up 7%, Brent up 8%. We've got gold up 1% to $5,300 an ounce. So there's some movement. in other parts of the market.
Absolutely. I mean, take a look at the Treasury market. 10-year Treasury yields higher by about 10 basis points. We were just having the conversation with Ed Yardeni, though. While that is a very sizable move when it comes to the benchmark Treasury rate here, I mean, we're more or less in the range that we've been in for several months here. So it's hard to get too excited.
Yeah, some of the moves here aren't extreme. You are seeing an extreme move in the dollar, euro dollar, having, at least for the dollar's perspective, having its best day going back to July of last year. And of course, we have to pay attention to not just, of course, what's going on in oil. We had that huge pop that we saw in natural gas futures over in Europe, as well as actually a big pop in aluminum prices as well, also a commodity dependent on the Straits of Hormuz remaining open. We get the closing bells in New York, and after a big drop down, a 1% gap lower for the S&P 500, it looks like we're going to end the day in the green ever so slightly. We're just going to call it unchanged. It takes a while for these numbers to settle, but the S&P will be up roughly about 1 or 2 points on the day. The NASDAQ composite is going to add about 80 points, or about 0.4%. The Dow Jones Industrial Average, that's going to finish in the red, but only down about 0.1% or so. And the Russell 2000, Katie, you pointed this out earlier, outperforming, up about 23 points, or about 0.9%.
All right, so some outperformance there. As Romain just mentioned, the S&P just a tad higher, call it pretty much unchanged here. Dig inside, though, the index, Katie, and by the way, good to have you back. 240 names to the upside, 261 to the downside, 2 unchanged.
I am thrilled to be back and tell you all about what the Circle is doing today. It's very interesting. You have about 4 sectors finishing in the green, 7 in the red, as you might expect. On a percent basis, energy, your big gainer on the day. As a sector, higher by about 2%, though. From a points basis, it was tech. That sector rallying about 0.9%. In terms of what didn't perform, consumer staples, a big slide there, down about 1.4%, really speaking to the idea that it wasn't too much of a risk-off move today. The fact that staples were your big loser on the day. Consumer discretionary, though, also falling by about 1%. So too did healthcare, Carol. All right, so that's a look at some of the major industry groups. Let's go to some of the individual gainers, if I may, in terms of the S&P, not the S&P, the overall trade. Palantir, number 3 gainer in the S&P 500, number 2 gainer in the NASDAQ 100. As we know, a big government contractor, so riding that rally higher today because of Middle East tensions, also being upgraded to buy from neutral over at UBS. It's the latest firm to turn more positive on the software company in the wake of its results. Again, Palantir up about 5.8%. Along those lines, let's take a look at the defense sector, because we definitely did see a rally, really rallying, to be fair, over the past year as global tensions ratcheted higher. This new conflict in the Middle East giving traders another reason to invest in the sector. So we saw investors moving into Lockheed Martin up 2.8%. Also Northrop Grumman, a gain of 6%. And then you've also got RTX, the ticker there, that went up about 4.7%. Energy names also higher in today's session. We saw strong gains really around the world when it comes to energy names because of the Middle East tensions and, of course, continuing attacks from U.S. and Israel against Iran. So ExxonMobil up more than 1%. You had Chevron up about 1.5%, and APA Corp, that went up about 4.3%. And then I just want to mention one other name, because we had 3 names moving as a result of NVIDIA agreeing to invest $4 billion in 2 companies that develop data center optics that are essential for artificial intelligence systems. So NVIDIA, that was up about 3%. Those 2 companies, NVIDIA investing $2 billion apiece in Lumentum Holdings and Coherent Corp, multi-year deals. And so you had Lumentum up about almost 12% there, Tim, and then Coherent a gain of more than 15% in today's session. So, yeah, some outperformance there.
10 gainers?
I thought I did it rather quickly and efficiently.
You did, but I'm very impressed. I got 3 decliners for you guys. Well, we can call them all the airlines. How's that? Down 2.5% today. This is the composite airlines index for the S&P 1500. So everything was actually in the red today when it came to airlines in the United States, from Alaska, Southwest, Delta, SkyWest, United, to American, Sun Country, Allegiant, and JetBlue. You did have airlines take a hit today. This not just on tensions around the world, and some airlines, including United, cutting off certain routes through the Middle East, like JFK to Tel Aviv and Delta doing that Delta doing that, but also higher fuel prices and what this means for demand when it comes to actually people traveling around the world. Our Bloomberg intelligence team writing that a prolonged U.S.-Iran engagement will reduce U.S. airline first quarter profits, especially for the large international carriers such as Delta, United, and American. Airlines as a whole down 2.6%. Also, speaking of travel, Norwegian Cruise Line holding falling today. The company out and saying that full-year net yields will be little change due to execution missteps in its commercial and deployment strategy. The company forecast earnings that came in below the average analyst estimate. The company also facing pressure from activist investor Elliott Investment Management. It disclosed a stake of more than 10% and criticized management decision and spending. Cruise stocks as a whole fell today, not just over what happened with Norwegian, but also oil prices surging the most in 4 years as a result of those military strikes. And finally, in the S&P 500, the worst performer, AES Corporation, BlackRock, Global Infrastructure Partners, and EQT agreeing to buy AES for about $10.7 billion in cash. They're going to pay $15 per share for AES. That's below Friday's closing price because this news had come out last week, but shares today fell, Romain, by close to 18%.
All right, I do want to just check in on yields, because when we talk about the big moves that we had in the cross-asset space, and how most of those moves faded, the move in yields actually did stick. You're looking right now, you have a 30-year yield that on a points basis having the biggest one-day increase since January. On the 2-year, the biggest one-day gain since October. And on the 10-year, the biggest one-day gain going back to June. And a lot of that has to do less with the geopolitical aspect of it specifically, but of course the ripple effects, the idea of a potential inflationary effect here, and the idea, as some folks have already said publicly, that the Fed ain't going to do anything anytime soon, no matter what the outcome of this happens to be over the next couple of weeks.
Yeah, certainly. An already complicated picture for the Fed gets a little bit murkier here. Meanwhile, earnings season continues to roll on. Let's quickly talk about what we're seeing come out of MongoDB, reporting that fourth quarter adjusted EPS actually beat estimates, coming in at $1.65. The estimate had been for $1.48. Also beating when it comes to fourth quarter revenue, coming in just above $695 million. The estimate had been for $670 million. So, you know, another reminder that the world keeps spinning, and certainly the engine of corporate America continues here, Carol.
Yeah, and a name down that's already down about 22% here in 2026. Hey, let's go to kind of some of the bigger, broader themes. And I think about the conversation Lisa Abramowitz had with Jamie Dimon, CEO, of course, of JP Morgan Chase. And he talked about more optimism being out there in the market than there should be, given all the risks. He talked about kind of warning that there's a lot of complacency in the market, that inflation is one of the risks. He calls it the skunk at the party. And he thinks that the probabilities of something going south are more than other people think, and that inflation will cause the economic downturn. I feel like there is momentum. I think of Lloyd Blankfein, again, making a reference to the great financial crisis. Jamie Dimon has done that. There's a lot of people, and they're not quite sure, not necessarily pointing full-heartedly at private credit, but watching the credit space overall.
Yeah, one of those people, Danny Moses, joined our program in the 2 o'clock hour. You know him from The Big Short and Moses Ventures, Romain, but he's been one to talk a little about concern when it comes to private credit, the opacity there, and if there is going to be a shoe to drop from private credit.
And we kind of forget, you know, too, in addition to the big conversation we've been having about private credit last week, we're also talking about the issues going on in the AI space with high valuations and the borrowing going on in there. You're throwing geopolitics over it. But we've seen this before, right? I mean, anytime you do eventually get to that point where you do have that big crash or whatever you want to call it, it's never really slow. I mean, most people are going to continue buying, continue to try to make money as long as they can. And that's probably what you're seeing right now. It's not that people aren't aware of those cracks, but until they really feel that that day of reckoning is actually here, why would you pull back meaningfully?
Yeah, it's interesting. I mean, I feel like at any point in time, you can make the case that markets look a little bit complacent. We do have such an interesting confluence of factors at this time. What is a little bit different, it feels like, versus past episodes in the past couple of years is the fact that you are seeing a rush for havens, at least when it comes to what we're seeing in gold, for example. So it's not like people are buying risk and that's it. There still is that demand for some of those safer assets.
And speaking of volatility, the VIX hitting 25 today, but finishing around 21. So we did see a little bit of a move up there. All right, guys, that's a wrap. An interesting Monday, to say the least. We'll see what the rest of the week brings. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine finishing up there on The Close on Bloomberg TV, and Tim and I continuing, of course, on Bloomberg Business Week Daily right here on Bloomberg Radio. We will see you again, same time, same place on Tuesday.
And our coverage continues here on The Close on Bloomberg Television, continuing to assess the situation in Iran and the impact across markets worldwide. We'll be back in a moment. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. It looked like it was going to be an ugly day for U.S. equities. A gap down for the S&P 500 of almost 1% to start the day, but it finished the session right around the waterline, 68.81 and change, basically flat on the day. Similar story for most of the other indices. In fact, with the exception of the Dow, all of the major indices actually did manage to finish in the green. However, the extreme price moves that we saw, they did stick a little bit more when it came to the commodity space. Brent crude futures up about 8% right now. They did trade above $80 a barrel for a brief moment. Keep an eye on European gas futures. They spiked about 50% at one point on the day, still up about 39%, and stickiness as well when it comes to the bid into the selling that we see into U.S. Treasuries, pushing yields higher on the day on your 10-year by about 10 basis points.
Meanwhile, let's take a look at some of the day's biggest equity movers, and boy, there were a lot of them. We start, of course, with Marathon. Energy stocks in general moving firmly higher. So too did Marathon, one of your biggest gainers in the S&P 500, higher by nearly 6%. Defense, also a big play today. Take a look at Palantir, shares higher by about 5.8%. On the downside, not related to what we're seeing unfold in the Middle East, but Berkshire Hathaway down nearly 5%. Remember, they had an update over the weekend there. The insurance business looking a little bit weak here. Markets underwhelmed with what we're hearing in terms of the company's future without Warren Buffett. Meanwhile, though, let's get back to our top story this hour, and that is President Trump doubling down, warning the U.S. will do, quote, whatever it takes in Iran. This comes as the UN's nuclear watchdog says that military action alone won't resolve ambiguity over Iran's nuclear ambitions.
At some point, this will come to an end, hopefully sooner rather than later. And when that happens, you will still have a question mark around these activities, these nuclear activities, and we will have to go back to the negotiating table. This is what we mean when we say we need a diplomatic solution.
Now the conflict rippling across markets, with oil and gas prices spiking as risks rise over the concept of $100 a barrel oil, Romaine.
Absolutely here. And when we talk about the political risk and the geopolitical risk, we've talked a lot about the effect on markets. But what about in the C-suite? What about in the boardroom? Kevin Kajiwara joins us right now, global chairman of Political Risk Advisory at Teneo, where he advises Fortune 100 CEOs and institutional investors on those geopolitical risks. Is this time different, Kevin?
Well, yes and no. It is different, I think, in the sense that, as I was talking to a lot of corporate leaders over the course of the weekend, I think many had become inured. Some of the media had become inured. Some of the administration had become inured to this notion that there's sort of these one-and-done shots. We saw it in Venezuela. We saw it in Iran last summer. We saw it in the assassination of Soleimani. That these things can be done very quickly and without any collateral damage or casualties on the U.S. side. This is very different and has the potential to be very different. And I think that's what's been somewhat shocking to some, notwithstanding the fact that there was a lot of signaling that this was coming.
I think one thing that certainly jarred markets too was the retaliation by Iran, not necessarily against Israel, but the idea that they were firing rockets into Dubai and Abu Dhabi and other places, financial centers of the world, in fact. And there was been a lot of concern as to whether CEOs need to start thinking about moving their people out of those areas or just make them shelter in place for a few days and hope this goes over. Were there contingency plans already in place for that potential, that there could be disruptions in what has generally been viewed as a little bit more safer and stable part of the Middle East?
Look, I think anytime you've got that much military hardware moving toward a known target, you should be thinking about what you should be doing about your people, your supply chain, your financial flows, all of those things. But nonetheless, the administration hadn't yet really put forward a rationale for why this action needed to be taken now, as opposed to this being a pressuring tactic. Indeed, the last official word we got was on Friday afternoon. The Omani mediators basically saying that negotiations were going to continue on Monday. So I do think that while people were getting ready, there wasn't this immediate sense of urgency. But I do think that thinking is changing certainly now. And I think that the bigger thought, though, is that it's in the context of something, Romain, you and I have been talking about for a long time on this program, which is that the global operating environment is changing, and that each one of these events is yet another data point that is confirming the notion that we are not going to be returning to any kind of status quo ante where the operating environment is more stable or more predictable.
I do also want to talk about what this means potentially for the U.S. relationship with China. We know that already things were tense there when you consider trade policy and sort of the posture there. But certainly, I mean, you think about how businesses trying to operate in both countries. How does this potentially further complicate matters?
Well, look, I think there's a few things, right? What China has been noticeably quiet, both on this and in Venezuela, right? Which I think to some degree is indicative of the fact that there's limits of what they can do beyond their own region, number one. Number two, I think they look at Iran. Iran is sort of number 3 or 4 on their list. I mean, it's a client state more than it is an ally, so they're not willing to go that extra mile necessarily. Medium term, I think that they don't mind the fact that the U.S. is getting bogged down in the Middle East as well as in Latin America and keeping out of the Asian theater. But longer term, there's also this element that, the world that the United States is playing a part in recreating here is one that is conducive to the aims and ambitions of Xi Jinping and the Chinese Communist Party. Having said that, I do think that there's going to be every effort made on both the Chinese and the American side to keep the Trump-Xi meeting at the end of this month on course.
Yeah, certainly. A whole bunch of topics just got added to that meeting, if it still goes through here. Kevin, I do want to talk about the days and weeks ahead and, what you think executives and companies will be watching for, because there's the question, of course, of employee safety first and foremost. But you think about some of the other factors, this rise that we're seeing in energy prices, gas prices when it comes to Europe. What will be top of mind as maybe we get more clarity and more developments?
I think duration is going to be really, really critical here, because these points about energy prices and the like, you would assume that market reaction would be what it was over the course of the weekend, which would be an immediate spike, right? But, Iran has never demonstrated an ability to keep the Strait of Hormuz closed as an example. So longevity or the duration of this is going to be a really, I think, absolutely critical question.
Is there a sense, though, too, and I want to look at it also from the side of what's going on in Washington. It seemed like a few months ago there was this attitude that kind of the volatility, if you will, in terms of policies coming out of Washington had kind of settled down a little bit, or at least it kind of maybe just hit a plateau. And then the idea that the president took this action, at least based on public reporting, seemingly without notifying allies, notifying Congress, and there's obviously a lot of talk as to whether even some of his generals knew what was going on. Is that now something that corporations should pay a little bit more attention to, that potential volatility in Washington is going to be elevated?
Well, I think one of the realities that we've seen since the mini midterm and since some of these special elections that have happened since, and watch the primaries in Texas tomorrow as another example, right, is that there is starting to be intra-party pushback, right, on the president, and there is going to be probably maybe multiple votes on the president's ability, the warfare ability, right? These will be more symbolic than anything else, but it will put congressmen and senators on the record on their view, which does in and of itself create an element of political pressure. So yeah, that volatility is going to build.
All right, Kevin, always appreciate your insight. That is Kevin Kajiwara. He is Global Chairman of Political Risk Advisory over at Teneo. Now, coming up, our coverage on Iran and the impact to energy markets continues with Amrita Sen, founder at Energy Aspects. That conversation up next. This is The Close. Whatever it takes, that's the message from President Trump when it comes to the war with Iran. Joseph Cirincione, he is vice chair at the Center for International Policy and author of Nuclear Nightmares, Securing the World Before It Is Too Late. He joins us now. Joseph, great to have you with us. I'm curious what you make of the end game here, because certainly we were just talking about with Kevin Kajiwara, it wasn't clear to many folks who had been monitoring this situation, just the urgency behind what we saw this past weekend.
Yeah, well, thank you, Katie. And that was a terrific interview. That was really informative. There is no clear end game. It doesn't appear that the President of the United States has an end game. As you saw from some of his media appearances today, he's all over the place. The war is going to last 4 or 5 weeks. The war could end in 2 or 3 days. I want to talk to them and make a deal. No, we're going to destroy their nuclear and missile capability. I don't see a good end game here. I think Iran's end game is to draw this out, is to regionalize the conflict, is to make the countries that they believed are behind this strike, particularly Saudi Arabia and the UAE, to pay a political and economic price for this, hence closing the Straits of Hormuz, hence hitting their facilities. We haven't even seen them do serious attacks on the oil refineries next, but I got to believe that's coming. I think the Iranian endgame is to wait the United States out, believe that President Trump will get bored, believe that as oil prices continue to spike, the economy globally will suffer, and that will pressure Trump to end the war, despite the entreats of Bibi Netanyahu, who seems to be the mastermind behind this, and the desire of MBS, the Crown Prince of Saudi Arabia, to deliver a fatal blow to Iran. I just don't see it happening.
Is there any sense here, though, when we talk about, I don't know, whoever's left of the current regime, the hardliners, if you will, here, if they are taken out, is there some sense here that there is a more moderate potential group of leaders that might be willing to negotiate with the U.S. and the rest of the world with regards to the nuclear program and just generally being, I guess, quote unquote, a good neighbor?
There were more moderate leaders, for example, President Rouhani, who made the Iran nuclear deal. Remember, we had a deal with Iran. The moderate elements in Iran succeeded in talking with the United States and the Obama administration, and they gave up most of their nuclear program. They broke it down to really a token size. It was put in an iron box, surrounded by cameras, inspectors, SEALs. Their nuclear program wasn't going anywhere. Trump pulled out of that in 2018, promising a bigger, better deal that could solve it. That was never delivered. And now he seems to have been convinced by Bibi, according to reliable reporting from a host of news sources, including the Washington Post and CNN, Bibi seems to have convinced him to do a regime change operation. That's what prompted the strike on Saturday. Not an imminent threat. There was no imminent threat. Even the Pentagon admitted that yesterday. But there was an opportunity to kill dozens of Iran's leaders, which they did do. But that did not decapitate the regime. This is not like Saddam Hussein's one man, one rule government, or even Muammar Gaddafi's one man, one rule. No, this is a deep, embedded, generational revolutionary mechanism that's controlling Iran. The Revolutionary Guard has 200,000 members. The militia has 1 million members. They're not going anywhere. You can kill a lot of these people, and the regime will still maintain power.
Joseph Cirincione, Vice Chair at the Center for International Policy. And Katie, we should just point out to our viewers that the Secretary of State, Marco Rubio, is on Capitol Hill as we speak, presumably letting Congress know exactly, I guess, why the U.S. did what it did, but more importantly, sort of what comes next. And I do wonder if there is going to be more of an articulation of what the strategy is going forward.
Yeah, absolutely. We have heard from several secretaries today, one of them being Defense Secretary Pete Hegseth, saying that, there's no appetite here for an endless war. That's not what they're trying to do, that this is not Iraq. Those are his words. But certainly there have been a lot of parallels drawn that comparison made to the 2003 invasion of Iraq.
Well, you're right. I mean, we technically won that war in, basically a week. And of course, we ended up being mired there for years. And that is the fear here as to how do you sort of facilitate regime change without actually putting boots on the ground and putting our servicemen and women at risk. In fact, we should point out those men and women, we have already gotten an exact death toll from the Pentagon, at least 6 already killed. The transportation sector facing major disruptions because of the situation in Iran. Shipping companies rushing to reroute in response to that conflict. Lee Klaskow covers the logistics and shipping space for us at Bloomberg Intelligence, and he joins us right now. Now, Lee, I am curious, what is kind of the read-through or feed-through, if you will, on a ship? I mean, and I don't really just mean like the oil shippers, but, on a DHL, on a FedEx, on that general supply chain. Is there some sort of material impact that, if not, has not shown up yet, might show up at some point?
Well, there certainly is a ripple effect of what's going on in the Middle East for all supply chains, and it's going to hit us in the U.S. Eventually, the longer this goes on. For a FedEx, UPS, or a DHL, they obviously have these large, vast air freight networks. And the Middle East is an important hub. And so when that area of the world, you can't fly, or it's not safe to fly. So, things will obviously have to be either rerouted. It could involve losing some volumes. Right now, and as long as it's a couple weeks, it's probably not going to be that big of a deal for these kind of companies. I would say out of the 3 that I referenced, DHL is probably the most exposed to the Middle East relative to FedEx and UPS. But again, it's going to ripple into the United States, and that ripple is really going to be felt because of what the prices are at the pump.
Right.
So a lot of the carriers that we cover on the truckload, less than truckload and railroad side, they have fuel surcharges in place, and when fuel prices increase significantly, it becomes a headwind to their margins and earnings because of the lag effect. Railroad surcharges can be as much as 60 days, while trucking is more weekly, so they're less impacted.
Well, that's exactly what I want to talk about, fuel costs, because certainly, I mean, we keep talking about the fact that we got that ISM manufacturing report earlier today, and input costs were already on the rise. That's before you factor in what we're seeing unfold in the Middle East. But we keep talking about the notion of $100 per barrel oil. But even before we get to that point, if we sustain $70, $80, $90, what are some of the quantifiable ripple effects there?
Well, the impact's really going to be on discretionary income of the consumer. So, the consumer's been holding up when you look at it holistically. But, the reality is the people at the top of the income spectrum are in a much better position than those in the mid and the lower part. And so if they're spending more of their money on fuel, they're going to have less money to buy stuff. And that's what I care about, the movement of stuff. And that moves in trucks and railroads and airplanes and ships. And so there'll be less volumes. And this is coming at a time where there was a lot of optimism about, trucking rates because of what was going on the supply side. And this might kind of delay any recovery in rates that we were expecting.
All right, Lee, really great to get your thoughts. That is Lee Klaskow of Bloomberg Intelligence. And let's keep the conversation going. The Middle East hitting commodity markets today, oil surging amid a near halt to traffic through the Strait of Hormuz and a disruption at a major refinery in Saudi Arabia. Amrita Sen, founder at Energy Aspects, she joins us now. And Amrita, let's talk about the Strait of Hormuz, because for a lot of folks, that is the worst case scenario, that you do see a major sustained disruption there. I'm curious to hear your thoughts, whether or not that's a realistic scenario, and if so, what would that mean in your view?
So I think that's something we've been warning about for a while. It's not that we are saying the straits will be closed. We actually don't buy into the headlines that are even coming out now. These are things that the Iranians have been saying throughout the day. But effectively, shipping through the straits is extremely disrupted. And I think that's the key point over here. Because of the attacks on vessels, because of attacks on the ports, and there's basically insurers are refusing to insure ships as well. So we've heard from multiple, whether it's oil companies, whether it's shipping companies and refiners, they're either not willing to send vessels in, and there are some vessels that are already in the Straits, have loaded from countries but can't come out. So it's pretty much a standstill. And I think that's where the real issues are coming from, especially for Asia, which gets, over 50% of its crude from, over 80% of its crude from the Middle East. And as a result of that, they are now scrambling, and they might even have to cut runs because they can't get the crude on time.
One thing, though, I am curious, Amrita, at least based on the reporting we have, that right now that a lot of this sort of, blockade of that channel is more self-imposed by a lot of those shippers. You mentioned, of course, the insurance, the lack of being able to get insurance. And if you pull up MapGo on your Bloomberg terminal, you can see a lot of those ships, both the oil and LNG ones, basically just kind of parked not far outside there. I guess maybe potentially waiting for some sort of all clear when it comes to safety. In the past, when we've had these types of disruptions, how long do they usually last?
Well, we haven't had something like this for decades. And in the past, I think it was in the 1980s, you actually ended up having the U.S. Navy escort ships. And I've heard rumors about that today as well. Again, none of this is substantiated, but I think that is essentially the fear in the market that if this lasts for a week or even longer, do they then have to get escorts? Or, you can't carry on like this. Even a week of disruption will lead to severe shortages in Asia in particular.
All right, Amrita Sen, founder over at Energy Aspects, jumping on the phone for us to give us a perspective here from the market participants. We continue with that story and take a closer look on where people are actually betting that oil could end up out of all this. There is a threat of $100 oil, which may make it risky to invest in U.S. equities. This is what our next guest writes. Equities reporter Alexandra Semenova joins us right now here in Studio 2. We had a big spike. We're still, at least on Brent crude, kind of right below that 80 level, 70s on WTI crude. What actually gets us to 100?
So this is not an immediate threat just yet. It was really interesting to see this morning when I got to my inbox, traders, strategists were saying that this is a dip buying opportunity. They don't see the threat of oil impacting stocks just yet, but that $100 a barrel level is kind of the tipping point where equities kind of go sour if that threshold is reached. So Morgan Stanley's Mike Wilson, for example, in the morning said that this doesn't really alter our constructive view on equities. He quickly pointed out that anytime we've gotten geopolitical volatility in the past, the S&P 500 has been up 2%, 6%, and 8% on average over the 1, 6, and 12-month period. But he did say that when you see a substantial increase in crude oil prices is when things get risky. That's when it starts to take a toll on consumers and on corporate earnings. We're not quite there yet. Bloomberg Intelligence also did a study where they found that the $100 a barrel level was kind of when equities faltered over the near and medium term.
And the last time we were there on WTI was in 2022?
Yeah, absolutely. It also feels like this market just likes to fixate on big round numbers. Obviously, $100 a barrel, big and round. But you also make the good point in your story when it comes to maybe the more optimistic bent that you take a look at the U.S. It's the largest oil producer in the world. Of course, this economy is maybe more well-suited to handle some of those levels, those very scary levels we're talking about, than it would have been in decades past.
Yeah, and I think also the key point is that economic growth and corporate earnings growth continue to be resilient, and that is what is holding this optimistic view on equities overall. We've seen so much happen this year, from private credit concerns to AI disruption to so much geopolitical risk, including today. And people are still kind of pointing to the fundamentals. Any kind of short-term selling that we've gotten has been really disconnected from fundamentals that actually are really strong. We're still looking at double-digit earnings growth this year. And that's what everyone was pointing to today, why we kind of closed little changed after erasing a 1.2% drop in the S&P.
Absolutely. Well, Alexandra Semenova, great reporting as always here. Meanwhile, let's take a quick look at how markets closed on this day, a very volatile Monday, to be sure. The S&P 500, as Alex just mentioned, we did manage to close just about flat on the day, erasing quite a mighty drop. Meanwhile, you take a look at Brent, sustaining those gains, higher by more than 7%. European natural gas futures higher by a whopping 40%, and the 10-year Treasury yield higher by about 10 basis points. This is the close.
All right, in the last hour on The Close, you heard from BNY CEO Robin Vince about the amount of money his bank is investing in new technologies, including AI. A big part of making those investments pay off, though, it actually lies with two key executives, Cathinka Wahlstrom, BNY's Chief Commercial Officer, and Carolyn Weinberg, BNY's Global Head of Product and Innovation. I had a chance to sit down with them earlier today for an exclusive conversation. Here's what they had to say.
AI has been really important to us on this transformation, and client onboarding is a great example. I think in the industry, the average to onboard an institutional client is something like up to 100 days because teams have to go through hundreds and hundreds of documents. So this is an area where AI is really helping us and helping our processes, automating our processes. So one part of that process is research. We have to do a lot of research when we onboard clients. And that used to take us a couple of days, and now it takes us 10 minutes.
I want to talk a little bit just about the proliferation of digital assets and the types of clients that are now coming to BNY for help in making sure that they have the ease of transaction and, more importantly, the safety associated with it. Mm-hmm.
So digital assets is clearly one of the mega trends, and I would say pretty much all our clients are interested in talking about it, whether they are a private company, a public company, or they're one of the new digital assets companies. To all of them, though, we provide traditional solutions, traditional assets, and then it's our ability to be in that intersection of traditional and digital assets. So obviously stable coin, tokenization, all very important for us to have. But this innovation is also about innovating with our current products. So one product, one platform that I'm very excited about is Collateral One. It is an integrated platform for our buy-side clients, and it really helps them to optimize their assets, so both to meet their investment goals, but also to lower the cost of funding. So it's sort of that intersection of securities, finance, liquidity, their derivatives trading counterparties all in one place. So as we think about innovating, as we think about the role of AI, it's really both on the traditional side and the digital side. And I'm really excited that last year our new head of product and innovation came on, and she really every day looks across all our different products and solutions, whether they're digital or traditional, and asks the question, in the combination of the different businesses that we have, could we create new and integrated solutions that might be unique because of all the businesses that we have? So as I look ahead, as I look at 2026, a lot of that is continuing to accelerate all the great things that we've done, but also bringing more new solutions to market.
As we sit here in the C-Talk, you could see the remarkable scale that this firm operates at. And you can see all of the systems, and our traditional systems power tens of trillions of dollars of assets settling and trading every single day. And then when you combine that with the new and the latest technologies of digital assets and blockchain, which is a 24/7 programmable, always on, it's pretty amazing what can be done. So
that 24/7 nature, is that here now or is that the future?
So we have here at BNY a BNY chain, and that is an always-on blockchain that powers many of our clients inside the house. It's not a public chain. It's a private permission chain. And as we connect our scaled systems with that chain, it enables them to enact and do things all the time, so 24/7. At the same time, there's a huge opportunity to connect many more assets, other books and records, and other transactions on-chain 24/7 that we're still in progress of doing.
The push that we've seen into tokenization, how does that actually fit into what you do?
So what's nice when we think about storage, so we are an amazing storage firm. We store about 60 trillion of assets for our clients. That's custody. But mobility is about tokenization. It's about the ability to move those assets faster. And we've seen over time settlement cycles go from T+5 to T+1, and actually now you can get closer to instant settlement with certainty. Because if you know that those assets are sitting here in custody, tokenization can enable you to move them faster and with certainty, because a tokenization element is really just representing where is that asset from a books and records perspective on a blockchain. And a blockchain is an always-on computer, essentially. So imagine if you had systems that never shut down. They didn't have batch process. So what's happening from a books and records perspective, from a tokenization perspective, is that we can use the handwritten ledgers that Alexander Hamilton wrote for our books and records. We can use computer systems that do shut down on batch process and restart just like most do, or you can use an always-on system to track all of your assets in custody. So over time, what we see is tokenization is really about representing real-world assets and securities and so forth in a way that enables you to mobilize them.
I am curious. I mean, you're relatively new to BNY, but you've been in the finance industry for a long time. How much have you seen clients, the complexion of clients, and what they want change over the years?
So clients want certainty of settlement. They want speed. And they want to know what they have with us from a custodial perspective.
And that's just basically across the board. That hasn't changed. That's
that
basically what
changed.
it was probably 200 years ago when you guys were founded to today. Just the assets on top.
Absolutely. What do I have?
Yeah.
How mobile is it? Are there insights that you can give me? And what the blockchain and digital assets enables for our clients is that exact demand, if you will, but with, again, auditability, programmability, and even customization. So they often are not asking us, can you please tokenize my assets? What they're asking is, I would love to do this transaction. Can you ensure settlement? Can you ensure certainty? Can you ensure various things? And we have the technology, and we enable the technology with many of our partners to do this.
That was Carolyn Weinberg, BNY's Global Head of Product and Innovation, along with Cathinka Wahlstrom, the Chief Commercial Officer, part of the conversation we had earlier today, Katie, about the bank's push deeper into technology.
Meanwhile, we do want to bring you a quick bit of breaking news here. The U.S. mulling capping NVIDIA H200 sales at 75,000 per Chinese buyer. Of course, a really interesting headline to get in the context of what's going on geopolitically. You can see NVIDIA shares moving slightly lower. Not a big reaction yet, but we will continue to monitor this story. This is The Close. Well, in addition to geopolitics, we also have a slew of retail earnings out this week, including from Target and On Holding, both reporting tomorrow morning. Joining us now to discuss what's ahead is Deborah Weinswig. She is founder and CEO over at Foresight Research. Deborah, great to have you with us. Let's start with Target. This will be the first opportunity for their new CEO to take the helm during earnings season. He officially became CEO just about a month ago. Target has been on quite a run so far in 2026. What will investors most be interested to hear from this new CEO?
Well, first, thanks for having me on. And I do think it'll be really critical. He's made some leadership changes already. So I think that there will be some wanting, if you will, of who will be filling some of those roles that are still unfilled yet and what that looks like. So number one, I would say leadership. Number two, they've been very open, which we all appreciate, that they've had, inventory allocation, demand forecasting issues. So basically on-shelf availability. And, they talked about last quarter. I think we're going to see kind of what progress they've made. Third, they have been incredibly early in agentic shopping. And I do think that does have something to do with their stock price performance. So while they're dealing with a lot of these, let's say, kind of old world problems, they're very kind of on the cutting edge of a lot of what's happening from an AI perspective, which I think is unexpected. And then lastly, what's happening with kind of store performance and new store openings, as well as what's happening on the merchandising front. So I think there's a lot for them to talk about, and there's a lot of interest here.
I am curious, though, about some of the missteps that they had in the past that sort of led to the impact on sales, issues that really weren't just about kind of, economics in the market, but more about obviously some of the political issues, if you will, here. Do you think he's ready to address that? I know there's been some reporting that at least internally there have been a few memos sent around on it.
I mean, I think a lot of some of those politics were driven by the prior leadership team. And I think Michael's very much about execution as opposed to, right, he wants to do what's best for Target and Target customers as opposed to kind of making it more than that. And that's, I think, why the stock has been rewarded as much as it has, was like kind of we're getting back to basics in terms of, right, merchandising, store execution, technology. And I think the street really liked hearing that. And I think the more that they continue to iterate that, the better.
And just quickly here, Deborah, we also hear from On Holdings tomorrow. Outside of just the results themselves, I mean, you think back to the Supreme Court decision in the past couple of weeks, basically striking down a whole bunch of President Donald Trump's tariffs. On Holdings, one of the companies that filed suit, asking for a refund there. What kind of commentary are you hoping and maybe expecting to hear from the company on that front?
It's actually a tough. First of all, great question. We kind of spent a lot of time around this, and the challenge, and it'll be interesting to see if it comes up on the earnings call, is not only the refunds that the retailers are asking, but we're starting to hear about class action lawsuits from consumers. Because sure, it's great if the retailers get, kind of back what they spent, but then that needs to kind of fall down the funnel further. And so they may be opening themselves up to, I think, more than what they might have originally thought. So that's kind of one thing I think to think about. And then secondly, on the positive side, right, we continue to see this category, and specifically OWN, see outsized growth. And that is also on a global scale. So I think what they're seeing in terms of consumer behavior, I think there's going to be a lot of focus on that.
All right, Deborah, always appreciate it. Deborah Weinswig, founder and CEO over at Foresight's research target, well off of its all-time highs, but a big rally, up about 29% since late November, the last time it reported earnings. Meanwhile, On Holdings up about 12 or 13%, Katie, since that last earnings report out of them. We do want to go back to that breaking news out of NVIDIA. Apparently, the U.S. mulling capping those H200 chip sales at 7,500 per Chinese buyer. Katie Greifeld, that's about half of what some of those buyers were actually looking for.
Yes, 75,000. Also, shipments of AMD's MI325 chips will also count towards that cap, according to people familiar with the matter. So AMD and NVIDIA in the crosshairs remain.
That does it for us here on The Close. All your political coverage is up ahead at the top of the hour with Balance of Power.